Welcome to Voices, everybody. Our guest today takes a multifaceted approach to asset allocation. Neither is he a strict fundamentalist, nor on the flip side, a totally technical wonk. But he's done extensive research into asset allocation and currency models based on central bank and bank credit creation factors. He's chief investment advisor to ProfitFund.com and also the CEO and founding partner of Tokyo, Japan-based Profit Research Center. Richard Werner is our guest on the show today. Richard, good to see you again.
Thank you very much. It's a pleasure.
I can't think of anything more interesting than in-depth research into the mentality of central banks. What actually piqued your interest here?
Oh, it's just the age-old search for the truth. There were just too many open questions and inconsistencies, and you start to wonder, well, hang on, what's really going on here? And then well, I mean, the scientific approach is, I'm also a professor of banking at a British university. You set out and look at the fact that the data, starting from the legal structure to the actual transactions and details, and you put the facts together. And the conclusion is that the story we're being told by the central banks just does not add up. And there is evidence that central banks work differently from what they would like us believe as to how they work. And
Very interesting.
We should discuss, I think, yeah.
Well, okay, let's talk this issue through then. Central banks are not one person. Central banks are not the person who, say, a President Bush appoints. I mean, he's got a lot of people on the board. It's a somewhat sort of a quasi-democratic process in terms of deciding what to do on the policy front. You mean all those PhDs all together sitting in a room for a couple days, as is the norm in many countries, in many economies? You mean they don't have their act together? They have some sort of a conflict of interest, or they have an ulterior motive which is lost on most of the public? Well,
you've raised a lot of issues here. We've got to take them one at a time. First of all, the issue of the structure of central banks and the decision-making process, and whether that's accountable to democratic institutions. I would say, actually, it's I mean, you may have all sorts of views on the Bush administration, but there is a certain legal process. There was an election, okay, disputed, but with central banks in almost all countries worldwide, and the IMF has helped a lot in achieving this, they've become totally independent and in practice not accountable to any democratic institution, and accountability to parliaments is usually minor and in practice meaningless, and the ECB is a great example. Here's the European Union and the Euroland, a part of it. The sort of the second biggest, or perhaps the biggest economic region in the world in terms of various measures, and it's controlled by the ECB, which is totally independent, unaccountable to anyone. And did you know this? Even basically criticizing the ECB and trying to get the ECB to change its policy, strictly speaking, could be considered illegal according to Article 107 of the old Maastricht Treaty. So there's, the legal structure is extraordinary if you actually look at it. But that's one thing. The other one is, okay, what really happens? Who makes the decisions? And most of all, what are these decisions? Now, of course, what we all start out looking at, and that's what we get from your excellent coverage and from other media coverages, the interest rate decisions. And, the sort of reading of the tea leaves when they make statements concerning accompanying the interest rate decisions. Now, that's based on the idea that interest rates are the key variable that drive economies. And, of course, we've heard it all, we've studied it. Lower rates lead to higher growth. Higher rates, slow an economy, lead to lower growth, and also linked to equity markets. Usually higher rates bad for equities, and vice versa. Now, that's repeated so often that nobody is questioning it, because everyone assumes, well, surely, everyone knows this is true, isn't it? Well, check it. There is no empirical evidence for these assertions whatsoever. For example, if you plot a graph where you have interest rates on one axis, and you have economic growth. So keep it all nominal, keep it all simple. Nominal growth on the other axis. What will you get? And if you have a scatter plot, you will get a positive correlation for virtually any country. And it doesn't matter whether you look at short rates or long rates. They're positive. So higher growth and higher rates go together. Lower growth and lower rates. Now, what about the timing? Which one comes first? We're being told it's the rates that are driving the process. That's why central banks are moving them to move the economy. Well, the empirical evidence is that there's no evidence that rates drive the economy, and if anything, there is evidence that the causation is likely to be the other way around. The economy is driving rates. Now, on the short end, what central banks are doing, that's actually quite obvious, and we've had discussions on how central bankers are always behind the curve, right? When do they lower rates? Well, after the economy has slowed. When do they raise rates? Well, after the economy is accelerated. What about the long end? What about the bond market? Well, actually, even here, the market is behind the curve. When the economy is found out to have been far stronger than expected, well, that's when rates go up. There's an announcement, as you've seen it all the time in your daily coverage of the various markets. Then the bond market jumps or falls. So, and that you can show statistically quite easily. So the interesting thing is this: the conclusion is, the reality is that rates follow growth in the economy. So the causation seems to be from the economy to rates, and the correlation seems to be positive. Now, this is different to the official story in two dimensions. The correlation and the causation is the opposite. So, for example, we're being told lower rates lead to higher growth. Well, the reality seems to be higher growth leads to higher rates. Now, on one level, we sort of, the traders will say, yeah, I know that, that's true. In a way, we know this, but we tend to forget it the moment a central banker comes out and makes a statement, because they will assert simply again the old story. But there's no empirical evidence for this. Now, why is that? Why do we have this hang-up? Why can't we accept the reality that there's nothing in the interest rate story? Rates follow. Rates are the result. They cannot therefore be the cause of growth. I think the main reason is that this raises another huge question. If it's not rates that's driving the economy, what on earth is driving the economy? Because basically both growth and rates are driven by a third factor. And what is that? Do you want to hear it?
Of course I want to hear it. I'm waiting for the punchline here.
All right. Well, actually, you just have to give me half a minute.
Okay.
And I'll lead you there. Why this focus on interest rates at all? Where does that come from? I mean, when did people start out to focus so much on rates? In the past, actually, until the late 70s or early 80s, that wasn't the case. So if you go back, you'll find that ultimately it goes back to the theory, the textbooks, economics, finance textbooks, where you have basically only one graph in economics, prices on the one vertical axis and quantities on the other. And if a demand curve downward sloping, supply curve upward sloping. And where the two meet, that's equilibrium. And do it for money. The price of money is rates, the quantity of money on the other axis. So prices change, interest rates change to give us equilibrium between demand and supply of money. And it's based on this theory of equilibrium. And then prices are key, and the price of money is interest rates. That's why it's thought interest rates must be key. It's 100% based on theory. Now, this theory has a number of assumptions, and as you know, economists are pretty good at making assumptions. Number one, perfect information. Well, Bloomberg would be out of business immediately if that assumption held, I'm afraid, and so would I in the financial sector. The financial sector wouldn't exist. So
kill that assumption. Kill that assumption right now. Okay?
Exactly.
Kill that assumption. Okay,
kill that assumption. So what happens? What happens now? Well, none of these models apply. There is no equilibrium. No market is in equilibrium. And then we're in a different world. You can throw out 99% of all textbooks on economics and finance that talk about equilibrium. They all do, because there is no equilibrium. So what happens next? Markets that are not in equilibrium, which means all markets in our world on this planet are rationed. Rationed markets are determined by quantities. And there's only one very simple rule, the so-called short side principle. Whichever of demand or supply, that quantity that is shorter, smaller, that will be the transaction quantity. Now for money, and that's the answer now, for money it's very simple. Bernie, I ask you, what is likely to be larger, the demand for money or the supply of money? What do you think? Think of your own wallet. The demand for money?
Well, it's going to be demand in my case, but if my government is printing it and making it worthless, then it's going to be a supply problem.
Oh, issue. Oh, then you need to demand even more, right? It's always going to be demand that's bigger. Now, the question is very simple. You're already thinking it one step further or two steps further. So if we stick to the question, what is at any moment in time likely to be larger, the demand for money or the supply? Think of all the small, medium-sized companies. Think of the 10-year recession in Japan. Yeah, rates are low, 0, but the quantity of money was stagnant. Why? Well, small firms had a tremendous demand for money. The government was borrowing a world record amount of money. They had a demand for money. What about the supply? It wasn't supplied. Always, it's the supply of money that's likely to be smaller, and therefore that's the quantity that determines everything, and that is the answer.
Okay.
The quantity
Richard,
of money supplied.
We'll continue this. In many ways, folks, I think we're uncovering what seems to be some sort of a conspiracy theory when it comes to central bank mechanization.
Did you have to mention that word?
If indeed that is a term. We'll be back with Voices right after this.